Hello everyone. This is the explanation of the homework problems, the answers to the homework problems for our discussion about stock compensation and earnings per share. So we have two problems to review. The first one has a compensation plan, two compensation plans actually. One that involves stock appreciation rights or SARs, and another that involves stock options. Most of the time, these two types of plans will start out with no journal entry because at the time that they are established, there is nothing earned and therefore there is nothing to record. And so typically at the beginning of these plans, there is no journal entry. But after a year, things have changed and we need to record some of that. So for instance, looking at the stock appreciation right plan, over time, at the end of the first year, the stock price has gone up from the reference point of $20 to $23, and that means that each person that has a stock appreciation right is going to get at least as long as things continue this way, $3 times however many stock appreciation rights they have. The $3 is the difference between 23 and 20. So you take the 200,000 stock appreciation rights as we look at the whole plan in aggregate, you multiply that by the $3 that they're going to receive, then you divide that by 3 because they're going to earn that over 3 years, and you get $200,000, which, as you see there, is debited to compensation expense and credited to the liability for stock appreciation rights, because that's going to be paid in cash. The second plan has to do with stock options. In this case, we are not worried about the $20. We are worried about the value of each option. Now, in this case, there are 400,000 options granted. Each of them has a value of $4 using the Black-Scholes method, and that fair value is going to stay constant through the whole plan despite changes in the stock price. So that $4 is going to stick with us. And we take that, multiply by the 400,000 number of options, and then we divide that by 5, because in this case, this stock option plan, this compensation is earned over 5 years, not 3 like it was under this stock appreciation rights plan. So that $320,000 is a debit compensation expense. This is not a liability. This is a credit to equity, specifically additional paid-in capital stock options. Now, moving forward to the next year, we look at the stock appreciation rights, and lo and behold, the price has gone up. And so now each stock appreciation right is worth $6, the difference between the $26 and the $20. But some people have left the company and forfeited their stock appreciation rights. In fact, 20% of them, leaving 80% left, or 160,000 stock appreciation rights. Times that by 6, and we get the amount of compensation that is going to be earned. We divide that by 3 to get how much is earned in a year. We multiply that by 2. Why do we do that? Because we're at the second year of the plan. So at this time of the plan, everybody should have earned 2/3, or 66% of the compensation expense. Okay, so then we figure out that amount, and we subtract from that what we've already recorded, the 200,000 from the year before. So compensation expense that should have been earned so far is $640. Subtract the 200 from last year, we get $440, and that's a debit to the expense and credit to the liability like it was in year 1. Same principle under the stock options. We have 320,000 options instead of 400,000 because we had the same percentage forfeited. Still multiply by 4 because that, like we talked about earlier, is going to stay the same. Divide by 5, multiply by 2 because we're at the second year. Next year it'll be 3, next year after that it'll be 4, but multiply by 2 for the second year, and then subtract what we have recorded from previous years. In this case, there's only one previous year, the 320 from last year. So we get 192 to debit compensation expense and credit APIC stock options. So if it would have been year 3, then we'd subtract all compensation expense from the previous 2 years. So fast forwarding to the end of our plan when we actually have to pay people out. At that point, if the plan ends, the actual amount finally determined. Remember, all of these are estimates because we don't know what the value of the stock will be at the end. But we do, by question number 4, we know that the price ended up at $25 or $5 over the reference point, and so that's $5 per person that has a stock appreciation right. There's 160,000 of those, and so that total amount that's going to be paid out is $800,000, and our credit should be cash. That $800,000 should equal all the credits to stock star liability that we've made earlier. Now notice that it doesn't because we only showed the journal entries for 2 of the years, not the 3rd year. But if you had all 3 years, you would see that the credit should equal this debit, and therefore the liability is wiped out, and you have a credit to cash. On the stock option side, similar principle in that this is how much would have been credited to additional paid-in capital stock options for all 5 years total, which is 320,000 options, which was what we ended up with, times $4. Remember that $4 sticks with us. Cash is what we're going to receive. Those 320,000 options are going to be redeemed, and each time that they get redeemed, they're going to pay the company $20. The employee is going to pay the company $20. So the company is going to receive $6.4 million in total, assuming they're all redeemed at once. And then add those two together and you credit regular additional paid-in capital rather than additional paid-in capital stock options. Now many companies combine these two. If you do that, then you have simply a debit to cash and a credit to additional paid-in capital for the $6.4 million. Now moving to the earnings per share calculation. It's got a little bit more math than that last one. We start with 4,260,500 shares outstanding. We add to that the 200,000 restricted shares that are vested. Vested shares are included in basic earnings per share calculation, and we always start with the basic earnings per share before we move to fully diluted. So we start with that number that's outstanding for January, February, March, 3 months. Multiply it by 3/12 and we get that number. On April 1st, we buy back stock. We buy back exactly 250,000 shares based on how much was given to us as we spent and the price that we spent per share. That lowers our number of shares outstanding by 250,000. That's outstanding for the month of April. We multiply that by 1/12. Then the 1st of May, we have another change. There's an exercise of options, which means that the employees bought stock, they paid us money, and the number of options that we have outstanding go down, but the number of shares we have outstanding goes up by 75,000. That's the difference between these two numbers. That's the case for May, June, July, August, September, and so that's multiplied by 5/12, and we get that number. Then we buy another 250,000 shares out the market, so our number of shares outstanding goes down by that amount, and that's the case for the rest of the year, October, November, December, 3/12, and multiply that, and we add all those up, we get 4,260,500. So we're dividing net income, no preferred dividends to worry about, net income divided by this denominator, or WASO, is $1.63 per share. Now, once we have the basic, we can start looking at fully diluted. We always start with stock options. We had 350,000 stock options outstanding at the beginning of the year, and that doesn't change until May 1st when 75,000 of them are exercised. We go from 350 to 275. 350 is outstanding for 4/12, 275 for 8/12. We multiply that out, add it up, and we get 300,000 weighted average options outstanding for the year. So how do we deal with that number of options? Now that we have that, we treat them using the treasury stock method, which means we assume that when they get exercised, and that's what we do, we're assuming that they get exercised, that we're going to use the money we receive from that exercise to buy back stock. So when we do that, we're going to receive $50 and we're going to buy them back at $65, which means we can't buy back as many as we issued. And so this is how much we issued, this is how much we bought back, and this is the difference. So that's the new incremental shares. That's the assumed dilution or number of shares that we now have to divide up net income with going forward. That's for options. Now, restricted stock works very similarly. We have 300,000 of unvested shares in restricted stock. Those unvested shares are treated just like options. They are part of the fully diluted, but not part of basic. So for all 12 months, that was the same number. We were given the same value for those as we had for the price of our options. So our 300,000 ends up buying back 237.69, just like the options. And the difference between the two is the new incremental shares. So because the value was the same and because the number of shares was the same, this actually ends up being a duplicate new incremental shares. All right, so now that we've got those two, the restricted stock and the options taken care of, now we look at the convertible bonds. There's no convertible preferred stock to worry about. We first figure out how much interest is saved if we converted the bonds. So if we convert the bonds, we don't have to pay interest on them. We calculate that by taking $3 million times 3%, and then we take 1 minus the tax rate, and the tax rate was 30%. So our interest only really costs us 70% of the interest cost because we get to save taxes as well. So that's our savings. And then if we did that, we would have 60,000 new shares because each bond of the 3,000 is converted into 20 shares. So 60,000 new shares. So our numerator, or our top number in our calculation, is our original net income plus the 63,000, or 7,009,000. Our denominator, the bottom number, is increased because we take what we had for basic, 4,260,000, add the incremental new shares for options, add the new incremental new shares for restricted stock, add the new incremental shares for the convertible bonds, and we get our new denominator. Dividing those, we get $1.57 as our fully diluted earnings per share. It always needs to be lower than our basic. That is required. If it's not, we either made a calculation error or we actually have a situation where the one of these elements is not dilutive and therefore shouldn't be used, and so we would ignore the diluted if it was higher than the basic.